Se você estuda finanças para se tornar um investidor melhor, já deve ter ouvido falar do custo médio ponderado de capital, WACC, Weighted Average Cost of Capital. Para entender o que ele significa, você deve saber que para que uma empresa exista, ela precisa de capital, ou seja, dinheiro para financiar suas operações. Esse capital pode vir dos acionistas que investem dinheiro na empresa em troca de uma participação nos lucros ou de credores que emprestam dinheiro em troca de juros. Cada um deles espera receber algo da empresa em troca do dinheiro fornecido para financiar as suas operações. O que o custo médio ponderado de capital faz é combinar o custo do capital próprio, o dinheiro dos acionistas, com o custo do capital de terceiros, os empréstimos, em uma única taxa. Uma vez calculada a taxa, você deve comparar com o retorno que a empresa gera. Obviamente, o retorno gerado pela empresa tem que ser maior do que o custo médio ponderado de capital que ela paga. Os livros de finanças apresentam a seguinte fórmula para calcular o custo médio ponderado de capital. Na fórmula, D representa o total de dívidas e E representa o total de capital próprio, equity. Veja que ela é dividida em duas partes. Na primeira parte, nós calculamos o custo da dívida e na segunda parte, o custo do capital próprio. A primeira fração representa a proporção da dívida em relação ao capital total utilizado. Isso será multiplicado pelo custo da dívida, ou seja, a taxa de juros paga pelos empréstimos, ajustada pelo benefício fiscal que a dívida traz no resultado. Os juros pagos no meu empréstimo são deduzidos do meu lucro e eu pago menos imposto de renda. Segundo a teoria, esse é o custo do capital de terceiros, que será somado ao custo do capital próprio para acharmos o custo médio de capital. E é nessa parte que essa fórmula começa a se afastar da realidade. Você deve multiplicar o percentual do capital próprio por uma taxa livre de risco, normalmente considera-se títulos de longo prazo emitidos pelo governo, beta, que é uma medida de risco que indica o quanto a ação é sensível ao movimento dos mercados, vezes um prêmio de risco, que é o retorno adicional que o investidor espera ganhar ao invés de investir em títulos livres de risco. Agora, vamos entender nesse vídeo a visão de Warren Buffett e Charlie Munger sobre toda essa teoria e o custo de capital.
Cost of capital first. Obviously, considerations of cost are important in business. And obviously, opportunity costs, which is a doctrine of economics, really a doctrine of lifesmanship, are also very important. And we've always had that kind of basic thinking. Of course, capital isn't free. And of course, you can figure cost of capital when you're borrowing money, or at least you can figure cost of loans. But the theorists had to develop some theory for what equity cost. And there they just went bonkers. They said if you earned 100% on capital because you had some marvelous business, your cost of capital was 100%. And therefore you shouldn't look at any opportunity that delivered a lousy 80%. That is the kind of thinking which came out of the capital assets pricing models and so forth that I've always considered inanity. What is Berkshire's cost of capital? We have this damn capital. It just keeps multiplying and multiplying. What does its cost? You have perfectly good old-fashioned doctrines like opportunity cost. You know, at any given time when we consider an investment, we have to compare it to the best alternative investment we have at that time. We had perfectly good old-fashioned ideas that are very basic to use, but they weren't good enough for these modern theorists. Mm-hmm. So they invented all this ridiculous mathematics, which concluded that the companies that made the most money had the highest costs of capital. Well, all I can say is it's not for us. Now, the other half of that question I leave for Mr. Buffett.
Yeah. Yeah. What you find, of course, is that the cost of capital is about 0.25% below the return promised by any deal that the CEO wants to do. Very simple. we have three questions on capital with capitals around, and leaving aside whether we want to borrow money, which we generally don't want to do. And one is, does it make it more sense to pay it out to the shareholders than to keep it within the company? The sub-question on that is, if we pay it out, is it better off to do it via repurchases or by a dividend? The test for whether we pay it out in dividends is, can we create more than $1 of value within the company with that dollar than paying it out? And you never know the answer to that, but so far the answer is, judged by results, is yes, we can. And we think that prospectively we can, but that's a hope on our part, and it's justified to some extent by past history, but it's not a certainty. Once we cross that threshold, then do we repurchase stock? Well, obviously, if you can buy your stock at a significant discount from conservatively calculated intrinsic value, and you can buy it in reasonable quantity, that's a use for capital. Beyond that, then the question becomes, if you have the capital, you think you can create more than $1, how do you create the most with the least risk? And that gets to business risk. It doesn't get to any calculation of the volatility. I don't know the risk in See's Candy is measured by its stock volatility, because the stock hasn't been outstanding since 1972. Does that mean I can't determine how risky a business See's is because we don't have a daily quote on it? No, I can determine it by looking at the business and the competitive environment in which it operates and so on. So once we cross the threshold of deciding that we can deploy capital so as to create more than $1 of present value for every dollar retained, then it's just a question of doing the most intelligent thing that you can find. And that is, the cost of every deal we do is measured by the second best deal that's around at a given time, including doing more of some of the things we're already in. And I have listened to cost of capital discussions at all kinds of corporate board meetings, everything else, and I've never found anything that made very much sense in it, except for the fact that it's what they learned in business school, and it's what the consultants talked about, and most of the board members would nod their head without knowing what the hell was going on. And that's been my history with the cost of capital.
The current freshman economics text, which is sweeping the country, has right in practically the first page, and it says all intelligent people should think primarily in terms of opportunity cost. And that's obviously correct. But it's very hard to teach business based on opportunity cost. It's much easier to teach the capital assets pricing model, where you can just punch in numbers and out come numbers. And therefore, people teach what is easy to teach instead of what is correct to teach. It reminds me of Einstein's famous saying. He says, everything should be made as simple as possible, but no more simple.
Write that down.